who bought it at $109 per share, which is a bit surprising, but we'll get to that once again in future lectures as to why the management of the company sacrificed $3 per share instead of taking the larger value. So at that point, it was seen as a huge success story. There were books written about it. The management of the company became celebrities. But what happened next was that approximately 15 years later, essentially the company was split into different divisions. So there's RGR Nabisco, and then sold off. And KKR, Kohlberg, Kravis, and Roberts basically decided never to participate in such an investment again. So what this says over here is that the fund, which was used to buy this particular company, ended up losing $730 million. That, mind you, is a very large number if we think about it in economic terms. And this company decided not to once again participate in such a merger, and RGR Nabisco was eventually broken up. Now, before we move on, are there any questions till this point? Any doubts? All right. So,
hi, Professor.
Yeah.
Can you listen? It's just to say that on my computer I can see a lot of people, but in yours we are just three. But you have a lot of people with a camera on.
I see. That's a bit odd. I mean,
like if you change the view, probably you can see a lot of us with a camera on.
That's very helpful. Thank you. If Microsoft Teams decides to work once again, I think I can do that. But yeah, my apologies.
Because in your computer we are just four, but on mine we are like a lot of people with a camera on.
Okay, then my apologies for.
No, it was just for you to know.
No, thank you. That is very helpful. I think this is the first time I'm kind of handling the Microsoft Teams. So in that sense, it's very helpful for you to help out with that. So that is the story of this KKR and RGR Nabisco, essentially the barbarians at the gate. I would highly recommend that you read this book if you're interested in mergers in any sense. Even if you don't take this course, it's a very interesting book to read, quite simply because it gives you an idea of how mergers and acquisitions essentially worked, and how the corporate culture in the US changed from a culture which was more prudent to a culture which basically became what it is right now. So this story also raises a bit of questions for us, which we will try to address during this class. And it essentially sets the roadmap for us for the rest of the class. First question is, why did the takeover occur in the first place? Why is it that RGR Nabisco decided to buy out its own public shares? As a company, you have so many options at your disposal, and buying out is not the only option. So that leads to this big picture question. Why do firms decide to merge, acquire, or restructure? You can essentially do a large number of other things like joint ventures, or just licensing, or independent contracts, or you can decide not to merge at all or go for just organic growth. Why would you want to go for something like a merger at all? Now, the second question is this really an exception? Because if this is an exception, that's fantastic for us, in the sense that if on average mergers are losing value, that's quite not a good thing for us as shareholders and also as taxpayers and as economists. But if this is really an exception, then it's just a nice story to read, that's all. So the question is, do mergers really create value? Now, the next question is, why did this merger result in failure? So the big picture question over here is, why do some mergers fail and others succeed? I will introduce a caveat at this point, which is that essentially it is there are multiple approaches to understanding why some mergers fail and others succeed, and we will only be covering a few of them. As an example, in management, there's a big literature which covers this directly. It talks about integration, and talks about due diligence and so on. But we will be covering some other aspects of this as well. The next question is, how did KKR choose the stock price of $109? So if you're thinking about this, why is it $109 the right price? Why not go for $200? Or why is the initial value of $55 not the right value? And if you're really sitting in the seat of an M&A analyst, where you have to essentially make recommendations or you have to issue reports, that is a big question. And even from the perspective of the management of this particular company, it's quite a big question. So the big picture question over here is how to value a company. And this particular question forms the core of this course. And finally, why did they choose an LBO, a leveraged buyout? Why did they decide to finance this via debt as opposed to choosing something else? So what drives the financing choices of firms? Some of these big picture questions are quite large, especially if we think about how to value a company. But as of today, what we'll try to cover is, why do firms decide to merge? Do mergers really create value? And why do some mergers fail and others succeed? And what we will do throughout this particular class is we will try to keep on going back to this Arja Nabisco story to give us some perspective, to give us an example of exactly how to answer these questions. Okay, so unfortunately, it's an either-or transaction for me, so I cannot see you while I am on the full screen. So are there any questions till this point? No? So let us proceed.
Sorry to interrupt.
Yeah?
Can you hear me? It's not about what you've just said, but can you tell us the Moodle password, please? So that we can self-enroll?
So the way it works is that you will first have a guest. Essentially, I guess you have a ad drop week, which is going on right now, where you can just audit classes. And then at the end of the ad drop week, then I will give you the access. I think as of now, the guest access should be available to you. So if it is not available, do let me know, because from what I can see from my end, I have made the guest enrollment.
No, it is. It's available. I just meant to ask you how to enroll in the class, but you'll tell us later. Okay, thank you.
So I will just put up the instructions later. It's quite simple from my understanding. I'm also not very familiar with Moodle. The way it works is you just have the code and you just have to put it in, and then you are enrolled. So let's start with the first question. Why do firms decide to merge? So if you're a firm, you have a wide range of options. It's not simply say merger is an only option. As an example, you can just choose to outsource, something which happens quite often, or you can just buy from other firms their products. As an example, Apple and Samsung had a deal for a very long time, even as competitors. But on the other hand, you have a wide range of corporate alliances. So as an example, joint ventures are very common in many developing countries where, a particular firm will form a joint venture with, say, a foreign firm to produce a particular product for a given period of time. So the control of these firms is not going away. They are simply collaborating with each other. So there's a whole spectrum of activities that a firm can take up. And at the other end, where the company essentially loses control or basically merges control, is mergers and acquisitions. So mergers are essentially where two firms come together as equal. Acquisitions is where one firm takes over the other firm. To once again repeat, the acquirer is the firm which takes over. The target is the firm which is taken over. So the question over here still remains, why is it that firms choose this And why is it that we are going to be talking about this dimension as opposed to everything else? So I hope you can bear with me because Teams is not exactly the most user-friendly software. So what I will try to play for you is essentially Mark Zuckerberg talking about the acquisition of WhatsApp.
Clearly, there's one topic that we have to start with. It's been on everybody's lips for the last week or so. You bought WhatsApp for $19 billion. Why did you do it, and what does it mean?
Well, WhatsApp is a great company, and it's a great fit for us. Already, almost 500 million people love using WhatsApp for messaging, and it's the most engaging app that we've ever seen exist on mobile by far. About 70% of people who use WhatsApp use it every day, which kind of blows away everything else that's out there.
But you paid $19 billion for it. I just fucking put myself in the head of your board here, right? You know, they do probably agree with you that long-term making the world more connected and open is a great thing, but then there are numbers people, a lot of them.
There's two pieces, I think, to think about. The first is it is a company by itself and what it's going to be worth. And then there's the strategic value and what we can do together. And I actually just think that by itself, it's worth more than $19 billion. I mean, it's hard to exactly make that case today because they have so little revenue compared to that number. But I mean, the reality is there are very few services that reach 1 billion people in the world. They're all incredibly valuable, much more valuable than that. So I mean, there's a halfway there already. I could be wrong. I mean, it's like there is some chance that this is the one service that gets to 1 billion people and ends up not being that valuable. I don't think I am. I think you can look at other messaging apps that are out there, and whether it's Kakao or Line or WeChat, that already are monetizing at a level of $2 to $3 per person with pretty early efforts. And I think that shows that if we can do a pretty good job of helping WhatsApp to grow, that this is just going to be a huge business, right? So even just independently, I think it's quite a good bet. Now, then the question is, why were we excited to do this together? So I was excited, and Jan was, because of the Internet.org vision and helping to connect everyone in the world, which I think clearly we can do and get a lot of leverage from working together on that. The other piece is that by being a part of Facebook, it makes it that they can focus for the next 5 years or so purely on connecting more people.
So to clarify, was everyone able to hear that?
Yes.
Okay, great. So let me then play one more for you, and then we'll discuss this.
The Instagram acquisition. Yeah, can you talk about it now? Why did you do it, and what are you going to do with it?
Oh, yeah, so Instagram is great, right? I mean, they're this super talented group of engineers. They're building this amazing product. They just crossed 100 million registered users, and they're killing it. And the history of how this thing came together is really interesting, right? So the way that I got to know Kevin is they started off building on top of our platform, right? They had just a great open graph integration that made it so that you can take pictures with Instagram, you can share them to Facebook, and it's really first class, right? So sharing a picture from Instagram, it basically the same as if you shared a photo on Facebook. So it's great. They did a really good job with that. And one of the things that I like to do is all of our big developers, I just like to reach out to them and get to know them personally. Partially because I'm personally just really interested in entrepreneurship and helping other entrepreneurs. Also, I just want to get to know the people who are doing great stuff on top of our platform. So I spent a lot of time with Kevin, and over the course of our discussions, we built this roadmap of all these things that we can do together. But then this tension started, which was, they were starting to get a lot of distribution from Facebook. And from them, there's this question of, how much do they want to bet on just one company providing a huge amount of their distribution, right? So that became a strategic question for them. And on the flip side for us, there's this question of how much do we prioritize these things, right? So we have this list of cool things that we can do. But then there's this question of, okay, well, we can help them grow, but this might just be specific for them. But without the value accruing to us, we'll probably get to these things more slowly than ideally we would want to. So eventually I just brought up the idea to Kevin, hey, maybe we should just join and become one company. We can do a lot of these things really quickly. And we decided to do it. So that's basically the game plan, is we're going to execute on the features that we decided earlier. Our mission around Instagram is we think Instagram is amazing and we want to help it grow to hundreds of millions of users. We want to help them out with whatever we can, but we have no agenda in terms of making them go onto our infrastructure. So I know a lot of times companies force companies that they're integrating to do stuff like that. I think it's primarily a waste of time. We're not going to do any of that. We're going to just try to do the things that we would have done if they were an open graph partner, but now we can prioritize them more highly, and they can do a lot of them directly because they have access to our code directly.
Okay, so I wanted to ask essentially, what was Mark Zuckerberg's perspective on why he essentially his company acquired WhatsApp and Instagram? So what did you gather from his perspective to answer the question, why merge, as opposed to say, engage in an alliance or not merge at all? Anyone? Yeah, Oliver?
Yeah, in the case of WhatsApp, he pointed out that the company was undervalued in his perspective. Also, he pointed out for Instagram and WhatsApp that there are like synergy effects because they're operating in the same industry. They're reaching some customers which Facebook maybe doesn't reach yet in other geographies. So I think the synergy effects are a big part of the value which is supposed to be created.
That's a very, very good answer. So that's precisely what I was going for. Essentially, the answer to why do firms decide to merge from his perspective was that, first of all, he felt that the company was independently worth more than $19 billion. So the first motivation was purchasing the asset below cost. If you see an asset in the market which is undervalued, even as a shareholder, if you think that a particular share is undervalued, which doesn't really happen that much, you would want to purchase it. The second dimension was the market access to more people, which is the strategic value. So in his case, he talked about 500 million people who already use WhatsApp. So there's the more strategic reorientation from his perspective to really take over WhatsApp. An additional dimension was that WhatsApp and Facebook will create value together, which, as Oliver pointed out, is essentially synergies. What synergies are basically where two firms come together and create more value than if they were to operate independently. Now, why don't we simply ask managers? Because in this case, WhatsApp and Facebook and Mark Zuckerberg, that's just one perspective. But we can go a bit further beyond that. We, as an example, had the survey of chief financial officers, which was carried out by Mukherjee, Gimas, and Baker in 2004. And what they did was they asked all the managers about their motivations to engage in mergers, whether they believe that mergers create value, and so on and so forth. So what this survey, the first answer, which was very popular amongst all the CFOs as the motive for engaging in mergers and acquisitions, was to take advantage of synergies. So approximately 37% of people said that. Another dimension is diversification. So instead of simply focusing in one area, you focus on a large number of different areas. We will also cover diversification much later in this course in conglomerates. The other reasons also include, say, strategic dimensions, which is the third most popular reason. Acquiring a company below its replacement cost, so undervalued company, using excess free cash, which is not necessarily seen as the best possible use of free cash all the time, because free cash often leads to agency problems, as you might have covered in your previous econ or finance courses or management courses. And then there are other dimensions which are, in the simplest terms, I can call them the violations of Modigliani-Miller theorem. Essentially that companies, the markets are not fully efficient. So the two most popular reasons are diversification and taking advantage of synergies, which is precisely, I mean, at least the first and the third reason is very close to what Mark Zuckerberg was talking about. So let's go a bit through the motives for mergers. Now, unfortunately, I couldn't get my iPad to connect to the Teams. So I'm actually considering going forward to potentially start using Zoom instead. But let me just give this a shot. Yeah, so now we can share the screen. Good. Oh, on this I can see everyone. So that problem is at least resolved. Okay, so the first motive is synergies. Can you see what I'm writing on the iPad or?
Yes.
Okay, great. So the first motive is synergies, and there are typically two types of synergies. The first type is operating synergies, and the second type is financial synergies. What operating synergies essentially consist of are economies of scale. And the second dimension is economies of scope. So I presume that you might have come across these terms previously, but what they mean, the economies of scale basically means that any company has a given fixed cost, and you can produce, say, more by just, at the same fixed cost. So as an example, instead of producing, say, 250 cars with a given machinery which cost around 100 million, you produce, say, 1,000 cars with the same machinery. So your fixed cost per unit goes down. That's the idea of the economies of scale. Economies of scope essentially link to, say, good linkages between different sections. So this is much more so about skill sets. As an example, one very good example of economies of scope includes Disney and Pixar, where the animation teams of these two particular companies can work really well with each other to produce much better movies than if they were to work independently, at least in theory. Now, financial synergies consist mainly of reducing the cost of capital. So the cost of capital of any given firm is the amount essentially that it needs to pay to raise capital. So in this case, reducing the cost of capital is a direction of synergies. And if we think about the sources of synergies, let me now stop with sharing this. Okay, so if we think about the sources of synergies, the managers themselves most often believe that operating economies, that is, economy of scale or economy of scope, is the primary dimension along which they get synergies. Financial economies are much less common, and this is also something that we see in, say, actual analysis, so data-based analysis, rather than surveys, where we see that typically most of the value of synergies arises from economies of scale or scope, rather than reducing the cost of capital. So that is one of the main motives for mergers. In general, when people think about mergers, even in layman terms, they think about synergies. The second motive for mergers is diversification. So diversification can take four forms, and I would not bore you with, say, each of these different forms, because also we are going to do conglomerates when we will be covering this in much more depth. But the idea of diversification is that you either acquire companies which are, say, unrelated to you or slightly related to you, or, I mean, this is not very good diversification, but companies which are overlapping with yours. Typically, if we are thinking about the best value which is created in diversification, it comes from higher growth, higher risk diversification, rather than the unrelated diversification, which typically doesn't create much value. So as an example, Amazon acquiring, I don't know, Apple. Well, Amazon and Apple have linkages, but Amazon acquiring ExxonMobil would not be a good approach, at least based on whatever we know about value creation through mergers. The third dimension is strategic realignment. This is a bit more self-explanatory. And the last one is buying undervalued assets, which is essentially you identify those assets in the market or those companies which are undervalued and try to take them over. So does anybody know what a Q ratio is? No? So a Q ratio is essentially, I can see, okay, yeah. A Q ratio is essentially the ratio of the market value of an asset to its replacement cost. So the market, well, this has already been covered. So yeah, the Q ratio consists of the market value of the asset to its replacement cost. In a different way, we can think about it as the market value of the asset to the book value of the asset. And the idea being that if the Q ratio is less than 1, then the company is undervalued. Why is that? Because if the market value is less than the book value, that means that the particular asset is undervalued. Now, there's a major motive for mergers where typically the idea is that merger waves or large clustering of mergers is actually driven when people believe that the Q ratio is low, so when assets are undervalued. And in a sense, you can see that over here, while there's no Q ratio plotted over here, what you see is that the used capital purchases typically align perfectly with acquisitions. So people, when they are buying, when they are buying specific assets or in the market, that would be around the time when these assets are undervalued. So as an example, there's a very well-known trend where, say, newer firms often buy older machineries of older firms. As an example, Ben & Jerry's started off by buying an old truck, to give you an idea of what these used capital purchases look like. Now, most people would buy these assets only when they are undervalued. And what we see is that when most people are buying undervalued assets or what they believe to be undervalued assets, firms are also acquiring other firms. And that is a major motive for the merger. So essentially, we have 4 main motives for mergers over here, one being the first being essentially the synergies, the second being diversification, the third being strategic realignment, and finally, we have the Q ratio. Okay, so one very quick question. I'm not at all familiar with Teams because I've used Zoom so far. So when I start writing on my iPad, can you still see the slides on the screen or does it go off?
We can't see the slides right now.
I see. So you can't see the slides. So, well, let me just see whether I have to type anything. Okay, then I'm going off the iPad call. This is so much fun. Okay. So can you guys see the slides now or still not visible?
Not yet.
It's unfortunate.
Not yet.
I am sorry about this, but unfortunately, I need to have a whiteboard on which I can write. So it's a bit difficult to work without a whiteboard. Let me see how I can share, because just give me a second. I think I cannot see the toolbar over here. So what I will have to do is leave the meeting very quickly and come back. Okay, apologies for all of this. I hope to get more technically proficient in sometime in the near future, but today is not that day. Okay, so can you see my screen now?
Yes.
Yes.
Okay, great.
Yes, we can see it. Thanks.
So what I was going for was that when people are buying a lot of used capital, that is around the same time when firms are acquiring other firms. So in other words, when small businesses, as an example, are buying, say, used up capital to, at cheap prices, that's exactly the same time. It overlaps really well with acquisitions. So are there any questions so far? And by the way, if you have any questions, just feel free to unmute yourself and start asking, because unfortunately, I cannot see you as I'm presenting, but nonetheless, it would be very good. I really don't want to prevent anybody from asking questions. So this essentially kind of tackles why firms decide to merge. But the next question is, when should we merge? I mean, even if you do have all the list of these motives, the idea is not that you're going to always go and take over other firms. It's not like Apple is always going to try to take over other firms at any given point in time. There is a good time and a bad time to engage in these mergers. And to understand whether a company should act upon these motives, we need some guideline. So let's turn to some basic finance, really rudimentary finance. What it says is that a merger is a good idea if the expected value of a deal is greater than expected value of no deal. Now, of course, do keep in mind that there are the dimensions, like, for instance, the cost of capital and so on, which do drive mergers, or the availability of capital as an example. But all of that is already incorporated over here, because what is expected value of any given security? It is quite simply the expected cash flows from that security discounted at the interest rate, which incorporates the risk. So expected value of the deal, that is essentially the expected value of the combined firm, should be greater than the expected value of no deal. And that is the idea where a company can use this guideline to decide whether or not to merge. But the question being, is it typically the case that expected value of deal is greater than expected value of no deal? So when mergers do occur, is it the case that this side, which is the sum of the combined firm, is greater than the individual firms? And that question really links to do mergers create value? Or in other words, do mergers create value for shareholders? So there are two dimensions to this. You have got this quite an interesting article over here, which says that mergers fail. So this is a dark side of things. It says that mergers fail more than marriages. So divorce rates in the US, I'm not entirely sure what they are in Portugal, typically are around 50%, even though they have been going down. And merger failure is as high as 90%. So probably mergers are not a great idea. They don't create value for the shareholders. Now, there's a second dimension where Stephen Kaplan, who is quite well versed in this, he says that most mergers do create value. The idea that mergers are essentially doomed to failure is a canard. When it comes to creating values, most mergers succeed. So which of these two dimensions is really true? Is it the case that mergers do not create value? Is it the case that mergers create value? In other words, is the Arja Nabisco case an exception or the rule? And as a shareholder, that's really important because if you're especially a large shareholder, you need to know when to intervene to prevent a merger. So if I really had to think about this, how would I really measure whether mergers create value or not? And that's essentially an open question. So how do I know if I had to really think about it? And I don't know much about, say, finance. How would I know how to measure whether mergers create value or not? Okay, so let me help you out a bit with that. One dimension could be event studies. Have you guys done event studies in the past in any of your courses?
No.
Okay, so once again, let's now go to my iPad and then let's try to work from there. By the way, there will be 2 sessions, and I personally intend to keep these sessions recorded. So what I will be doing on my end is that I will try to record the Friday sessions, the ones which are a bit later as compared to these ones, and then try to put them up in whichever way I can. And later, I think at halfway through the semester, halfway through the course, you guys are going to be the last session. So at that point, I'll start recording these ones. So essentially, I'll record the later sessions. And even if I think someone had asked this question previously, even if we do move online, as an example, in person, which I don't think is at least possible given the situation till beginning of March, at least for the last few lectures, I would like to have the lectures recorded and streamed. I'm not entirely sure whether we have the capacity to record all the lectures because only few lecture rooms have that. But I think even on a Mac or something like that, it should be possible to record the sessions. So I personally would not want anybody to, be unnecessarily coming to the lecture rooms. So event studies are basically, as the name suggests, identifying the reaction to an event. The reaction of whom? The reaction of the shareholders or the market to a given firm. So as an example, now suppose Apple releases an iPhone that is not a very straight line, but you get the idea. Suppose Apple releases an iPhone around, say, 23rd of March or something like that. Then what an event study would do would be that it would try to measure the stock price reaction around that time. So the stock return reaction, actually. Now, suppose it's a terrible iPhone. So what we will see is something like this, where to the event, the whole stock market reacts very negatively. Let me actually redraw that for you. That's not going to be very helpful. So this is the point at which the event occurs. And essentially around this point, this is where the event has occurred and you can measure the reaction. So the idea is quite simply to see the reaction of the market to a given event. Now, there are a lot of assumptions underlying this. The first one being that market knows best. If you have done, say, efficient market hypothesis in the past, we do know there's support, very strong support for weak form of efficient market hypothesis, but not so much for, say, strong form, which says that private information is also incorporated into markets. So The idea being that by looking at the reaction in terms of returns to a given event, you can see whether a given event is creating value or destroying value. So in this case, it is destroying value. Why? Because the market reaction is very negative. If this were just the opposite side, then it would mean that it's creating value. Now, it's not good enough to really look at returns, because before the event occurs as well, there's a lot of movement here and later as well. And by themselves, returns are not very informative, as we know in finance. So what we need to look at are abnormal returns. Essentially, what abnormal returns and the intuition underlying that is. And I don't think you need to think about the formula or anything at this point, is that the idea of abnormal returns is that is the market reaction greater than normal returns? And here normal returns or expected returns are the correct amount of returns or the appropriate returns that you should be receiving for risk. So if you're basically taking a certain amount of risk, then what is the appropriate amount of returns that you should be receiving? Those are your normal returns. And if the market returns are higher than those normal returns or lower than those normal returns, those are the abnormal returns. So the idea being, is the market compensating me more relative to what the normal return should be? Now, the way you calculate these event studies and do the cumulative abnormal returns is something I will probably put up a primer about. I don't want to unnecessarily derail the class by going on that whole side note. The idea you have to keep in mind is that an event study simply looks at the reaction of the market to a given event of a firm. So if we had to think about whether a merger is creating value or destroying value, what would we do essentially? What we would do is that we would look at the time when the merger occurs. Let's say this is time 0, and we would look at the acquirer being the firm which is going to take over. We would see how the market reacts to the acquirer. That is absolutely awful drawing. I hope you can forgive me for that. And how the acquirer reacts to target. Now, in this case, what is happening? The market is reacting negatively, actually a bit after the event occurs. Sorry, let me just get rid of this. The market is reacting very negatively to both the acquirer as well as the target. Just any line can be acquirer or target, but you get the idea. The returns are extremely negative, which means that the market believes that this particular merger or takeover or acquisition is destroying value. Because what is the price of a given share? It is the expected return of all future cash flows. So as an example, in this case, when the reaction is occurring, it's not necessarily just temporary. It basically says that the value of Apple is being destroyed for the foreseeable future, because essentially the share price of any given stock at any given time is supposed to accurately reflect its value. Now, whether that is true or not is a very different question, but nonetheless, at least we know that if that were true, then we can say in this case that the value is being destroyed by the merger. Is this clear so far? If this is a new concept to you, I am comfortable explaining it again, but I won't explain it unless you ask me to. So, okay. So then I will assume that all of you got this perfectly. Nonetheless, I will be putting up basically Yeah, so nonetheless, I will be putting up a primer for this. So in case you don't know this, you have not covered this in the past, then you should get an idea. So in this case, what you're seeing over here, I hope that you can see what I'm presenting, but if I'm not, then do let me know. So you should be seeing my slides at this point.
It's okay.
Okay, good. Thank you. So what you see over here is the following. The blue line is the bidder, that is the acquirer, and the red line is the target or the firm which is being acquired. And these are public acquisitions. So public acquisitions means two firms, both of whose shares are available on the stock market, as opposed to private firms, whose shares are not available. And of course, we cannot measure for private firms this because the shares are not available so that we can't see the returns. Now, the event is happening here at point zero. And what we see is that, first of all, the market does seem to anticipate the news a bit, both for the acquirer and the target. But for the acquirer or the bidder, that's the firm which is going to do the takeover, the value is actually negative. Whereas for the target, it shoots up close to 20%. So what does this tell us? That if I were to take this and this line together, of course, this would be positive. So there is synergy being created. But most of the synergy is just going to the target shareholders rather than the acquirer shareholders. So as an example, if Microsoft takes over, I don't know at this point, running out of examples, but Microsoft takes over Amazon, not happening, but still, in that case, I, as a shareholder of Microsoft, I'm going to lose value. Amazon shareholders are going to get all the value. So if we think about this a bit more in the long term, here there's a study by Andrade, Mitchell, and Stafford who use all the United States firms. Essentially, the combined value here is positive of all the events. And that means that value is being created by these mergers. So the question over here that was asked, most mergers do create value. But there's also truth to this, which says that mergers are actually creating value for the target and not for the acquirer. So this is a short-run study. Why don't we once again, well, this is repeating what I said, but why don't we think about long run? So this is a study done by McKinsey where they asked the managers of firms, have you achieved the expected revenue synergies? What you see is that most firms, if they were actually achieving the revenue synergies, should be here, or at least here, close to 100%. But the vast majority of firms, even in the long run, after the merger has occurred, are actually somewhere in this ballpark, which is not very good for those firms. Because if you look at 23% of firms are actually achieving only 1/3 of the synergies or less. If we think about the expected cost savings, it's a bit better, but still, you should not be seeing so many firms on this side. So 25% roughly of firms, actually 38% of firms are actually not getting anywhere close to the cost savings they expect. So even in the long run, mergers do not seem to be creating much value. And that is a bit of a pessimistic side of mergers, because if we think about the merger industry, it easily ranges into trillions at any given point. And what I'm showing over here is that mergers do not create much value. And whatever value they do create in terms of synergies is going to the target or the acquired firm and not the acquirer. Now, there's this post-merger performance analysis where you can look at operating profit. Of course, there are major issues with this type of analysis, but still what it says is that out of 26 studies, 14 showed a decline in operating returns, but 12 showed an improvement. So this is a bit mixed. So overall, what I've shown you so far is extremely pessimistic version of mergers and acquisitions. But the next question that we will be asking is trying to disentangle why do mergers fail? And if mergers do genuinely fail, then, is it the case for all the firms or are there exceptions? And at this point, I think we are at roughly 1 hour, 15-minute mark. So let's take a break for at least 15 to 20 minutes and then reconvene. So I'll see you in a bit.
Sorry, Professor, can I ask you something?
Yeah.
Is there what is the limit for the group, for the assignments, like the members?
From my end, I think I would like to keep it around 3 to 4.
Okay.
But again, I'm more than flexible to shift it around. But where were you coming from on this? In terms of like what would be the ideal limit that you would want?
I think for us it's the same. Normally it's 5 in the other courses.
I'm okay extending it to 5 as well. So that's perfectly good. So right now it's 10:43. Let's try to be back around 11 or 11:05. So let's take a bit of a break and then let's restart. In the meanwhile, I am here. So if you have any questions or so on, then feel free to